Welcome back to Investing Talk Podcast.
Today we're looking at Cardiff Oncology.
As usual, before we start, subscribe, like, and comment to this video to support this show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Whenever we examine a clinical stage biotech like Cardiff Oncology, we kind of need to reset our expectations immediately.
Right.
This isn't your typical value play. We're not looking at revenue multiples or PE ratios.
No, this is a pure catalyst play, a binary event.
Exactly. The valuation lives or dies by clinical trial success, period.
Yeah. And you can see that reality plain as day when you look at their financials.
Yeah.
The company is, by definition, pre-revenue.
Mm-hmm.
They've generated exactly $0 in the last 4 quarters, which is, completely standard for a company at this stage.
It is. But what's fascinating here, what I find interesting, is how they're managing that cash burn.
They seem incredibly disciplined.
Precisely. We saw a really encouraging degree of cost discipline in Q1 of 2025. It shows that management is strategically maneuvering ahead of these really high-cost Phase 3 trials.
So what did that look like?
Well, their general and administrative, the G&A expenses dropped by a notable 28% year over year.
28%.
Yeah, down to about $3.8 million. And R&D spending also fell by about 19%.
Okay, so that reduction, it isn't necessarily a sign they're slowing down.
That's
It feels more like smart transition planning.
That's a great way to put it. They're optimizing their spend while their lead asset moves from one stage to the next, consolidating resources, ensuring maximum efficiency.
So let's get a quick financial snapshot for everyone listening. As of, the end of March 2025?
Yes.
They reported a respectable $16.1 million in cash and equivalents, and critically, 0 long-term debt.
That clean balance sheet is a huge operational advantage. So many small-cap biotechs are just drowning in leverage.
True, but we have to acknowledge the free cash flow burn. It was still pretty steep.
It was. It hit negative $8.9 million in Q1. But, and this is a big but, management has been very explicit about their cash runway.
What are they guiding for?
Based on their projected spend for 2025, somewhere between $25 and $28 million, they believe their current cash will last well into the 4th quarter of 2026.
So almost 2 years of breathing room.
Yeah.
Which brings us to the big question. If they're pre-revenue and burning cash, why has analyst sentiment shifted so dramatically?
Because the market is finally starting to price in the success of the science. Since late 2024, the average price target has just soared.
By how much?
Up 56%. It jumped from around $4.50 to $7.
And you have firms like H.C. Wainwright, JMP Securities.
Yeah.
They're all signaling that this company is at an inflection point.
All because of their lead program in acute myeloid leukemia, AML.
Okay, so let's dig into that science. This is where the proprietary tech becomes that massive competitive moat we've heard about. What's the fundamental difference here?
It all centers on their proprietary phosphoproteomic platform technology.
A mouthful.
It is, but this platform, developed at the Mayo Clinic and protected by a really robust patent, is their ultimate defense. They aren't just selling a drug, they're selling a diagnostic-guided therapy.
Okay, let's unpack that. For anyone listening who doesn't deal with oncology terms daily, why does functional profiling matter more than just, standard genomic testing in AML?
Well, in a disease like AML, just looking at genetic mutations, it often falls short.
How so?
A patient might have a mutation, but that doesn't actually tell you if the target protein is active and driving the cancer right now. Their platform measures the functional profile of kinase activity. It sees which proteins are literally turned on.
So they can select patients who are most likely to respond.
They're minimizing the odds of treating non-responders. It's a huge distinction. They're targeting the cancer's behavior, not just its blueprint.
And the main candidate doing this is CPO-470. That's their combo therapy for relapsed or refractory AML.
Exactly. And the differentiation of CPO-470 is really the primary source of all this optimism. It targets activated FLT3 kinase states.
And that's critical because...
Because it addresses the single biggest failure point of competitor drugs. See, traditional inhibitors often fail because the cancer develops resistance mutations.
Right, like the D835Y mutation.
It's the one. The competitor drug shuts down the pathway, but the cancer evolves this mutation to escape.
So how does CPO-470 get around that?
Based on their data so far, it appears to bypass or overcome that specific resistance mechanism. They've essentially built an escape route for the therapy itself. This isn't just a new drug, it's a resistance bypass mechanism.
Which is why regulators took notice.
And they took notice fast. The FDA granted fast-track designation for CPO 470 back in March.
And that's more than just a good press release.
Oh, absolutely. It means the FDA sees this as addressing a serious unmet need and is committed to speeding up its development and review.
Okay, let's talk numbers, because the data we have really supports this enthusiasm.
Yeah.
What are the key results from the Phase 2b trial?
The preliminary data from just 24 patients showed a 45% objective response rate, ORR.
45%. And to put that in context for people,
You have to look at the standard of care for these patients. They're heavily pretreated, relapsed AML. Historical response rates here are often in the low 20s, maybe 25% on a good day.
so hitting 45% is a potential paradigm shift.
It's a staggering difference. If that ORR holds up, it completely changes the outlook for this patient group and, well, the valuation of the company. It's the ultimate trigger.
And this is where it gets really interesting for anyone tracking the stock, the catalyst calendar.
Right. We are entering a very concentrated 2-month window where we expect some high-impact news.
Give us the timeline.
It starts in late May at the EORTC NCI ACR conference. They're set to present crucial biomarker correlation data.
Which will tell us why these patients are responding.
It validates the entire platform, but the really big moment is right after that.
ASCO.
The ASCO annual meeting, May 31st to June 4th. The expectation is an oral abstract presentation on the Phase 2b subgroup analysis. This is the clearest public view of the data we'll have seen yet.
This is the event that will basically decide if the stock hits that $7 price target.
I think so. And then following ASCO, we expect more guidance from the FDA in June on the path to Phase 3. So you've got data validation, institutional validation, and regulatory clarification all hitting within weeks.
It's the perfect setup for a binary event. But we
Yeah.
have to temper this enthusiasm. We have to look at the caution case.
We do. Not every program is equally strong, and the need for future capital introduces some very serious risks.
Right. If the AML program is the company's future, the secondary program, CDX527 for ovarian cancer, seems to be a drag on visibility.
And maybe on resources? The data, while scientifically interesting, it's far less compelling.
What were the numbers on that one?
The ORR was 21% in heavily pretreated patients. Median progression-free survival was about 4.7 months. I mean, those are marginal improvements compared to the blockbuster potential of the AML data.
And it seems like management knows it. They've said publicly there are no immediate plans for a Phase 3 trial for CDX527 without a partnership or more funding.
That lack of focus tells you everything about their internal priorities, which leads us directly to the primary risks.
Risk number one being
Clinical risk. If that flagship CPO 470 data disappoints at ASCO, let's say the ORR drops below 40% or PFS falls under 5 months, the entire bull thesis just collapses.
because the market is only valuing the AML program right now.
Exactly. And risk number 2, which is maybe more concrete, is the capital risk.
The dilution risk.
Yes, we know their cash runway extends to late 2026, but planning and starting a Phase 3 AML trial is incredibly expensive. We're talking over $50 million.
Which is more than their current market cap. So massive dilution is basically a given unless they sign a big partnership.
That's why you're hearing whisper numbers of a 15-20% dilution event by year-end if a deal doesn't materialize. They need a bridge to that pivotal trial.
But the speculative market is buzzing about this too. There's chatter about non-dilutive financing, like royalty advances.
Which would be a huge win. And there's also the unconfirmed talk about a partnership for the ovarian cancer drug, maybe co-development with a private biotech.
It's all very speculative, but it shows people are thinking about how to fill that capital gap.
Definitely.
So let's pivot to sentiment and the technicals, because it really seems like the smart money is positioning itself for these catalysts.
The institutional interest is undeniable. It's a strong foundation for the bull case. Total institutional ownership jumped from 52% in December 2024 to,
Get this,
a commanding 68% by March 2025.
that's a massive move. And you see firms like Eclipse Asset Management, Semsar Biocapital just piling in.
And that conviction is mirrored by the most informed investors, the insiders.
Or filings.
Yeah. They confirmed notable insider buys in Q1. The CEO bought an additional 125,000 shares in February. The CFO added shares too. When leadership is buying with their own money, that's a powerful signal.
And all of this belief translates directly into some compelling technical momentum.
Oh, absolutely. The stock formed a classic multi-month accumulation pattern, that bull flag structure, starting last September. And then you got the golden cross in December.
The 50-day moving average crossing above the 200-day.
A classic long-term bullish signal. And it all culminated in a huge volume spike in late March. 5.2 million shares traded versus an average of less than a million.
That's institutional accumulation, plain and simple, getting set before the big presentations.
So when you combine all of it, the breakthrough data, the regulatory validation, the institutional buying, the technicals, you arrive at a conclusion of asymmetric upside.
Explain that asymmetric risk profile for us.
At its current market cap, around $47 million, the company is trading at an estimated 60% discount to its peers at a similar clinical stage.
So a lot of the downside is already priced in.
It implies that, yes. But if that AML data hits in June and confirms that 45% ORR, the upside to that $7 consensus target is just wide open. The potential reward vastly outweighs the current perceived risk.
So to wrap up.
To conclude, Cardiff Oncology is the definition of a high-stakes catalyst play. The entire investment thesis, everything, rests on the CPO 470 AML program over the next 2 months.
It all comes down to the ASCOE data readout.
Or the swift execution of a high-value partnership to fund those expensive Phase 3 trials before the cash runway becomes a real crisis.
And that leaves us with a final provocative question. Given the significant insider buying and institutional accumulation we've seen, are these sophisticated players positioning themselves purely on the strength of that preliminary 45% clinical data?
Yeah.
Or are they accumulating shares ahead of an internal confirmed partnership rumor?
Like that unconfirmed chatter regarding Astellas Pharma.
Something for you to consider as we watch this all unfold.
It's going to be a fascinating couple of months.
If you found this analysis helpful, please remember to subscribe and stay tuned for our next company breakdown.